Good afternoon, everybody. This is Dan Hussey with ElliotWaveForecast.com, bringing you our our London session recap for November 11th, 2013. It's currently 11 a.m. Central Standard Time. That's noon or 12 p.m. Eastern. Just after the London session close here, and let's begin looking at the Aussie US dollar, as this is one of our more actively traded pairs recently, and it's basically we've been been kind of a net short on the Aussie for quite some time. Not quite, but we've been a net short on the Aussie with anticipation of continued downside at least into the 93-92 area. We've been looking for this full pullback for a long time. We have equal legs on this in this market that would put us down to about a 92. But I see anywhere between 93 and 92 here as our support, our landing area. We are probably would look to switch to net longs at that point, but you know, shorts are holding. Into last week we held. Let's draw this up here. We were holding extension shorts drawn from basically the 96 figure here down to these lows. We had traded once, went down to a new low, traded again, held 6-18 lines, and then continued to targets. This week we are watching, and the levels we held into the weekend, the resistance levels were these anchor to lows, these extension shorts that have downside targets at the 93.35s. Last week, about noon, halfway through the New York session, we sold the 93.90 figure. We only took 10 pips off of it on Friday. We closed out for the weekend. It was definitely a safe trade to hold over the weekend, and I chose not to, just to mitigate risk. Either way, this week we went down, broke, popped to new lows, and then rallied up into the 93.70s, which is where a halfway back short or the Globex short, in other words, today's high to today's low, resided. We were able to sell that. We took 10 pips off on a first target, and we're looking for 93.35 to 93.40 to take the second piece off. So really, we're only looking for 20 more pips to the downside, 20-25 pips to take the rest of this position off, and or I'm sorry. 15 to 20 pips to the downside to take the rest of this off. I don't even feel terrible pulling it right now and just closing out at plus 20, but it's short, it's free, and the Aussie has been systemically one of the weaker currencies of over the last couple weeks, so across the board. So I'm going to let this work. Again, we sold the 93 68s were our original orders. We force filled them at 66s and took 10 off at 56, and then are letting the balance ride with a 93.76 stop, so completely free. And it's 93.76 or 93.35s break even or profit target. So that's about all we have on the Aussie US dollar for now. Actually want to move to the Euro US dollar, and then we'll come back to the Euro Aussie. Stepping out to a 4-hour chart, we've gotten the reaction from the 127. Can minimize our positions here. 127.45 anchored to the 138.33 highs. The 133 level has gotten its reaction, and it actually got free. So for those that are unaware, that what that means is algorithms buy these 50% lines. This is the reaction you saw, was the algorithms buying it. Their stops are down below the 61.8 and 65% lines, and they use the 38.2% line to take a first target, and that's the resistance you're seeing. So you're not seeing sellers per se as much as you are seeing the longs from the 133 figure taking first targets. And those algorithms are designed to now ride with a break-even trade for either the 141 profit objectives or a break-even stop out. Interestingly enough, we have equal legs on the euro, would put us right down about that 6-8 line. Nothing says this market can't dip in below the 133 level. So anywhere between 133 and 132, if we get another push down, I am going to be looking to switch to a net long. Our mind was elsewhere last week when the 133 level traded. It was definitely, I was too enthralled in watching and managing my yen position at the time to have fired off a long here, which c'est la vie. The market will give us opportunities to get long, and certainly if we get above, the 135 figure, or at the very least, I want to see us above 135 450s. I would be, a buyer on the pullback of that, after that, for a swing towards 141 in either way. So, no, on a trade that has 800 pip profit objectives, there's you shouldn't be upset about missing 80 pips of it at this point. And be patient. Let the market come to you. It always gives you an opportunity to get in. And here it may actually give us an opportunity to get in at a better price than those 133s, because we are still going down to a 15-minute chart. We are still holding a resistance level from the 135.48 anchor to lows here. 618 lines were defended, and right now it kind of looks like we're in some kind of sideways chop. A, B, C, maybe get a couple more sideways moves here before we break lower. Maybe not. Just in today's price action and coming up off of the low on Friday, not the 133 low, we're able to reverse engineer a traditional long that held off this low. That trade went to and through targets, and now using the 133.74 anchor here, high to high, we can see an extension long that already traded to its target here. And then same anchor, new high, actually traded already in a front run of a couple pips. We were trying to be a buyer here at the 133.93s for a scalp towards 134.20. We pulled those orders because it just didn't fill. It's still a valid setup. Still, these little micro longs are holding, and once this micro long fails, if it does, before breaking through new highs, you're going to have, again, probably some kind of continuation in a range here before the euro. And like we said this week, we were anticipating kind of a sideways dollar price action, with the exception of the dollar yen, because it's going to be more of a yen move, and that's attributed to what bonds are doing. This is what we're kind of seeing, is this range in the euro, and the range is valid until it fails. We break out the range to the top side, we'll buy the pullback. We break out to the range to the downside. We'll look to see if that's a finishing push for this cycle off of the 138 highs, and then if this is a terminal push, if we do get some kind of terminal move down into 133, 132 area, if we can catch a reversal down there, a reversal setup down there, and hold it for a swing towards 141, that's my ultimate goal. So again, wait for the burst above resistance to break, confirm the cycle's over, buy the pullback, or wait for the burst down and then wait for a cycle reversal down here to buy the pullback. The euro is going to give you a chance to get in. It always does. Every market always gives you a chance. You just have to be ready for that chance if you didn't take it the first time, because the trade you wanted was these 133s and then take half at 134.25. So and you'd be long and free, and that's it. All right. Unfortunately, I didn't get in on that, but hey, doesn't mean there won't be opportunities the whole way up, or down, because who says we have to? The trade could break, but there's not only a daily target up there, but this 4-hour target as well. All right, now the Euro Aussie, definitely one of our more interesting markets that I'm watching. Stepping out to a daily chart, I want everyone to be aware that there is a major, it's one of the most technical markets we've had this year. There was a full halfway back long, defended 61.8 lines, went to and through targets, and now we're just simply pulling the extension in what could be a big B wave flat, running flat, and then this could be the fourth wave of a 1, 2, 3, 4, and looking for that fifth wave up to 154. So the Euro Aussie and the Euro Yen are my two keys for trading the Euro US dollar. We see a very mixed template across the U.S. currencies, which is why I'm not looking across the U.S. currencies for correlation right now. It's not there. Aussie U.S. dollars down, euro U.S. dollars up. There's no positive U.S. dollar correlation between all the crosses. Sure, dollar franc and pound and euro, they're doing similar things at certain times, but that's not where the correlation is right now. The correlation is in yen and in bonds, and not many people take a look and watch it that way, which is why I'm seeing that the euro US dollar can rally to 141 so long as the euro Aussie and the euro yen continue to rally. And the euro Aussie is coming off of a major 141 handle support. This is a huge level. There's 1,300 pips to the upside from here, and it's already moved almost 400 pips. So we're sitting just shy of 400 pips here. Great series, great trend off of these lows. Last week was we took a trade into the end of the week on Thursday. There was an extension short, traded once to target, same anchor, new low. Upon breaking here, let's go down to a 5-minute chart so we can see this exact setup. There was a series of shorts, extension short traded here. You can see it traded the anchor, went to its target. The next one broke, and upon breaking here, the 618 lines, we got into a great little swing long. My intention on this trade was to actually hold it and let it run. I mean, we did. We let it run to the 142 figure, and we closed it out that day. I kind of have this rule sometimes on trades where, like, when the market gives you 100 pips very quickly like that, just in a couple hours, you take the 100 pips, and then you look to get in on a pullback. And I'm not worried about missing the uptrend on this market. Yeah, it's continuing higher and good for it. There's gonna be a nice big pullback at some point, and the nice big pullback here might correlate with the euro US dollar taking a dip down to 132, and that's, I think, the time that we should be looking to get long the euro for those bigger swings. Okay, so right now, euro Aussie, we got long last week on Thursday, 140 95s. We took it off for plus 105 pips at 142. Again, the market then pulled back into a full long overnight. It got front run. I would have never gotten filled on my orders. I wouldn't have front run by 6 or 7 pips. I would have been front running by 4. So we would have just missed a fill. Went to target the next day. It actually continued up and through targets, and that's why we have a valid kind of hourly extension long drawn from the 142. Okay, drawn from 142.28 anchor to highs, and this support level comes in at 142.90 now. However, there is a series of micros here that was holding. Held extensions here. This is a 5-minute trend now, and the 5-minute trend then blew out and began from an anchor of a 142.60 anchor to high, which is what's actually trading today. This was the trade we tried to take today. It was same anchor, new high. After the 143s traded, went to target, same anchor, new high. We didn't get filled, so we're going to continue pulling same anchor, new high, and it is a valid setup. However, I would wait for the 42.90s, if they trade. So we have 2 valid support levels. We reverse here. Something I want to show you from a 4-hour perspective here. Coming off of our prior highs, this prior high right here, looking for this is important now, taking both of these highs down to lows. These aren't shorts I would take, because obviously these shorts haven't worked. They've gone straight through. However, what's important about the 2 pulls I just used is they're the counter trend. They're what the wrong side is doing. And the algos use the counter trend to determine for a reversal. So now that we're pressing against 618 lines, over the next 24 hours, if we get a burst through the 143.40s and we burst into the 143.60 and 80, we're going to look for now a ambush long setup. In other words, we'll kind of ignore these smaller extensions, and we're going to be looking for the bigger dip. And that dip is going to be 140, 150 pip pullback here to get long at like the 142.20s. It looks like somewhere in that area. That trade's not set up yet. It's not ready, but it's on our it's on the back burner. We're watching for the break in shorts and then the ambush trade that we can get in on and that's the swing. That's the type of trade we'd look for then, the swing towards, to take it as a swing towards 154. That's kind of one of our intraday signal kind of updates here. Wouldn't probably take that in the Scalping Room webinar. I mean, we might, but that's kind of a heads up to all of our intraday and Trade Alert subscribers that this is what we're looking for now. We're starting to look for that swing or the pullback for the swing towards the 154 figure, okay, to be more positionally long the Euro Aussie. We've been very patient with this pair, and some of our subscribers know we've been tracking this for 3 months now. I mean, before, we were up in this territory, maybe longer. Now we're pushing more like 5 months. We've been waiting for this swing. Same thing with the Euro. This is what we've been tracking and looking and waiting for months. This is why we're so patient with some of these crosses, and it looks like we're finally there. Okay. Real quickly on gold. A lot of people are looking at this as a triangle right now. I see this as actually shorts prevailing. I think we go down in gold, and I think 960s. The more and more I see this, the more and more I'm realizing we did a halfway back short for the year at the 1435 area. We broke longs. We pulled into a short here at 143. At 1342s. If gold gets a bounce, it's make or break at 1320. 1320s, I doubt it gets there because this is too many nested 1-2s. This is too much buildup on the short side. I think shorts already got their fills. They're either going to drive this market lower here and now, or it's going to fail and this market's going to go sideways for an extended period. So again, 1207s in the near term. 1060s is the technical daily downside target, with very probably the market actually falling all the way to 960 to do an all-time halfway back. That's just drawn from 0 to all-time highs. 960 is the level to watch, as this area is the full 50% long for gold. Like, we're talking generational low style pull and move in gold. That's the same thing that happened in the S&P and the stock markets at 666. That's the exact same type of pullback, drawn from 0 to all-time highs, and markets do that. They happen, they happen few and far between in lifetimes, but they actually do happen, and we're probably watching that play out right now in a market, and a lot of people don't even realize it or aren't even thinking about it at this point. All right, one of the most important charts lately, and important trends, is the dollar yen. The dollar yen has 5 up off of its 97.60 lows. Some couple areas I want to point out here. We'll talk about all of these. Why this 98.90 high is there. Yeah, there's the potential for a pullback to 98.50. Not denying that. But as of right now, this was already a gift. This was a complete gift. It was tough to take, but it was a gift. And the market's not going to give you any more gifts here if this is going to blow out. So traditional longs traded. We had extensions, and now those extensions come in. Technically, if we get a bigger pullback here in today or tomorrow, I see 98.80s as support, and I don't believe we're going below 98.80s before we get above 100. I'm actually looking at this market and thinking to myself, I think we do 100 within the next 24 to 48 hours, and we're going to start doing extensions drawn from the 98.90s to highs. Why are we doing those? Why would that level be our new pull for extensions? Well, this 98.26 traded once to target, same anchor new high, traded twice to target, and the last time this traded, after it traded and it hit targets, it never gave us the pullback into the next entry point at 98.75s. What we've been holding is actually the lows of the prior entry to new highs. And last Friday it traded, and it traded again and held support at this 99 figure over the week, or start of this week. Hitting upside targets of 99.40s, not only is that probably going to start a short squeeze and a stop run above 99.40, and really kind of cause this price action and market to accelerate, it also means that we're actually blowing out of the prior highs of our prior anchor, which means we would begin new extensions from our 98.93 highs to highs. So wanted to point that out. Plus, I mean, we technically have upside targets of the 100 area. We'll call it 100 even from those 97, or from the 98 figure, which held the lows of the 97.60s. So with that being said, I mean, path of least resistance is up on the dollar yen. This snapback reversal said it all to me. Stepping out to the daily, this price action, this kind of condensing price action, it needs resolution. And right now, all signs in the near term and the long term are pointing up. Extension just from measured move purposes, this thing has been flagging sideways, and an extension drawn from our highs at the 84.20s to highs. This full daily pullback traded at the 94s, and we've just gone sideways, and flagged inside the middle of this range, and now we're starting. Now it's looking like the market's actually picking up momentum to the upside. So we're going to see some resolution here in this week. This week we will very likely close, somewhere above 101 to 102, or potentially below 96. That's going to happen this week. This market can't afford to go sideways much longer. And the reason I say that is that the longer we go sideways, and we've been going sideways for 6 months now, just the more fuel is built up. And the more fuel, the more gunpowder, it's going to take the smallest match to ignite it, and really get this market moving. And the last 48 hours to me of trading have really been the show and the early predecessor. It's the last tremor, like I said, before the volcano blows. Okay, and I'm not saying this just because I'm actually long from 97 and below. I'm saying this because this is where all signs are pointing. The shorts are failing, the longs have held, and what we saw here was our prior swing. Shattered 61.8 lines, shattered them, and then the market immediately pulled back into halfway back long. At the very least, we have to at least 100 and a test of 100. And imagine the stops that are above not only that psychological level in this marketplace, but hitting 100 means now we're testing all of these prior highs. And these prior highs, each one of them has stops residing above it, including the 99.40s. And they're going to act like accelerants, just like any of these major lows. Each one of these lows has stops lurking below it, and it's going to be like an accelerant each time one of these levels gets hit. Okay. Trend is up. I'm not going to trade against the trend here. Like I said, I think 98.50s would be an absolute gift. I just don't see it happening, unfortunately. I think if you're not in dollar yen already, you're probably not going to get an opportunity until we'll go back out to our 4-hour chart, until we start breaking trend lines, which we've already broken one, but this is more the trend line I'm interested in breaking here, until we break trend lines and then do a pullback to retest them as support. Okay, and those happen. So I can't really give you a place to buy the dollar yen. Sometimes there's nothing to do. Sometimes you missed it, and that's, I think, the opportunity. That's the problem here. Is I think if you're not in dollar yen, I think you've missed the opportunity to be in dollar yen for now. Otherwise, you're just chasing a market into prior highs, and that's deadly. If you're hell bent on being a buyer, the only level I would trust my money with right now, and this is again if you're not already long, would be like the 98.80 area, using like a 20 pip stop, and then if it pulls back in the 98.50s, using a 30 pip stop there. But I can't openly tell you that I think either one of these are a good idea, because you'd be trying to buy halfway back of what has already shown itself as a major range here between the 98, because below, again, we're still in a range here. We're in a roughly 200 pip range, and we're at the top end of that range. So buying anything after a move off of the top end of a range is dangerous, because just from price discovery alone, we know resistance is here, we know support is here, we know it. The market already showed it to us, and now you're coming off of resistance. I mean, this thing, if it rolls over, it could roll all the way over and retest support all the way down here. And that's what ranges do. And this market has told us it's in a range. It's done nothing but tell us it's in a range over the last 6 months. Now, my favorite count, and I've gone over this before, is actually what I call it, or what is referred to as a, there's actually a, so this was A, B, and then there was actually a triangle inside of this. So it was a B wave triangle inside of this triangle, where you had the larger A, B, and then your B wave triangle, which resided here. A, B, C, D, E, right? To complete a B wave triangle, and then A, B completed. Wait. A, B. I'm sorry, a C wave triangle. A, B, C, D, E, and then you had A, B, C, D, E real quick, and 9760s was the end of your E wave. So if that's true, this market's gonna, it's gonna look like this pretty soon. So really shallow pullbacks in this type of situation make trading tough. Sometimes you just didn't get the trade. Sometimes you're just not in the market. And I hate to be the one to break it, be the bearer of bad news in those situations, but you can't chase a market either. And that's something else that's important to remember. You can't just chase a market because you're not in it. You know what I mean? So Euro yen definitely has a nice bullish response here. We're coming up off of the 3160s, which was a prior support level. Didn't get to targets and came back down in kind of this expanding flat. So I'm seeing the euro yen is completed, and I think it's onward and upward to the 136.50, 137.30 area. So we've got another 400 pips to the upside in the euro yen. That gives the euro US dollar several hundred pips to the upside, even if the dollar yen is rallying. So and this could continue higher. So after those, but going down to a 15-minute chart last week, it was extremely technical. Let's go through kind of the breakdown of what happened last week. There was a Globex short traded to target, next in the series traded, broke, but by that point it had already given a reversal of a extensions had failed, given a reversal, and then began extensions itself. So we traded an extension long here, which broke out and has begun new extensions. So now we're doing the 32.56 anchor. It's traded once, twice. Now same anchor new high here would do a pullback into 32.86 and continuous higher. Of course, a full halfway back long here has the potential. Now that going out to an hourly chart, so we can see the full swing off of our prior highs. So long as this long trades before the short, it's a valid down to 132.20s. But this could continue higher, break the 134s, and then give us the larger pullback. So it's definitely got the setups to take us higher in the near term. It's definitely bullish. I don't see resistance here for another 20 pips above. So any pullback I think can be bought, particularly the 132.20s, as long as it trades before the 133.40 area. But if we do get up here to 133.40s, you want to see this go through all the way to 133.80, and then then you can buy the pullbacks after the 133.80 to 134 area breaks. Okay. The Aussie US or Aussie yen. It's basically the same idea here as the Aussie US dollar. Looking short, has set up hourly setup from the 94.20s, has downside targets in the 92s. Inside this setup, it looks like we front ran. They were really aggressive at these 93.20s, 7-8 pip front run. Sometimes it does that. Either way, 92 to the downside is next, and no support until 91 area. Let's go out to a 4-hour chart so we can take a look at where, you know, the extensions here, equal legs extensions on the Aussie yen come in right down here at 91. So A, B, and then this is your C wave down to 91. I like being a buyer down there. I'm not going to do it. Well, maybe we will for our signal purposes, but I like being a buyer down there for the swing higher. In my opinion, it's when Aussie yen turns is when all the other yen crosses are probably going to be accelerating higher, because Aussie yen being at the so dollar yen and Aussie yen are at opposite sides of the carry trade spectrum. Aussie yen has the highest carry, positive carry, right? But it's falling, yet dollar yen is rallying, and that's because of the change in the US rates you're seeing in the bond market. When the Aussie yen finally turns, it's going to, like when it moves, the acceleration that's going to be occurring in the other yen crosses is going to be astronomical, like the dollar yen. So I wanted to point that out, that once I think we get down to 91s, that's when I think the dollar yen is probably going to be really like in its stride. Its wave 3 of 3 up is going to begin when the Aussie yen turns from its area. And that's just the acceleration we're getting from the general carry trade correlation, because it's this is one of the few carry trades that's completely debuckled from the rest of the group, and the reason being is because the opposite side of that the curve, right, is rallying. The dollar yen is rallying as U.S. rates are rallying in the ZN. So that's what you're seeing here, is that money is a finite thing, and it moves if it's you know, if people aren't putting money into the Aussie yen, it's got to go other places, and it's all a natural flow. It's like a river. Water flows downhill, and then you know, until it hits a dam. And that's kind of what you're seeing now being created by the dollar yen and U.S. rates as they're actually starting to rise. The water is getting backed up, and if it gets backed up enough, you know, it could reverse the flow of the river. You know, it's just a constant pendulum of movement between two entities. If it's not in one, it's on the other. Guys, I've already covered the euro. You can recap the video when we're done. It'll be available for watching, but I already did already cover the euro. The S&P 500 now, last but not least here. Stepping out to our daily chart so we can see. Let's actually go back on the S&P. Let's remove everything here and do a kind of a long-term thing here on the S&P. And there's something I want to show everybody that I don't think we talk about enough. And unfortunately, I feel like nobody talked about this enough, and it's kind of a joke to me. I just can never believe that people don't see this kind of stuff, you know, as it goes on. I'm going to get rid of all of this stuff. Delete all drawings. Perfect. Now I'm going to add to this chart. This is the S&P 500, and one moment, guys. There we go. So I want to add a study here. I want to add 2 moving averages, just simple moving averages. This is a monthly S&P chart, basically from the 28 crash through today. I mean, if this thing looks bearish to you, you should just give up trading. So we're looking for the 55. The 50-month and the 200-month moving average. These are very important indicators. Let's go back in time. Let's go back in time to the 1920s crash. Now, if you were to extrapolate out, you kind of have to here, the 200-month, you can imagine how sometime back in 1930, I don't think it's too hard to see how sometime back in 1930. Oh, sorry about that, guys. Still get used to this platform. If you extrapolated this line out, back in 1930, after the stock market crash, for the first time in the history of the 50-month and the 200-month moving averages, we had a death cross. In 1946, we had a cross back over. In other words, the 50-month crossed back over the 200-month. And for 70 years, going on 70 years, the 200-month has never, or the 50-month has never crossed over the 200-month, including in 2012. We came really, really close. You can zoom in here, and you can see we never had the crossover. It just came barely away. Well, this is important. And the reason I say this is important because this is one of the few technical indicators you can use on a long time frame to help gauge where you are in terms of super cycles for the market. And I want to go back to the first full halfway back that the market did. And it was in the 1970s recession. And you can see that halfway back here. And I'm going to pull up a fib tool. And we're going to pull from 0 to the highs. And you can see how the market just literally stopped right at its 50% long. And I want you to be very aware of this period of time, basically 1969 through 1982, or 1980, 81. We'll call it this, now let's just say 79. We'll just keep this 10-year period. The market created a very, very apparent structure. Pulled back, went to a new high, and pulled back again in what we call an expanding flat correction. From 0 to all-time highs, the market halted at the 50% line, did not invalidate the 61.8, and eventually continued on, and in 1983 hit its negative 23% target. Exactly 14 years after the highs that began the recession, the 70s recession, targets were filled. Okay? Exactly. And in 1978 to 79, basically 5 years after the lows in the market, the 50-month and the 200-month moving averages came very close to crossing, the closest they've ever come before finally turning away from each other. Okay? Let's fast forward now to our market. What do you see? This shouldn't be rocket science. From highs to lows, up to a new high, and down to a new low, and an expanding flat correction. Drawn from 0 to all-time highs, the market traded its 50% long, failed to break its negative 60 or its 61.8 line, and we're already well on our way to our negative 23% targets up at the 1935-1950 area. Okay? Exact same structure. The lows in 2009, only 4 years later now, the 200-month and 50-month moving averages come very close to crossing but don't, and the market finds itself at a new high. Let's go back in time. Go back in time again to the 1970s. Boy, doesn't that look similar. We're somewhere right in here. 1981, 82. There's probably going to be a big pullback. You can see the structure coming up off these lows. How there was a major pullback within 3 years before a push up into new highs before another major pullback. Well, if history is going to repeat itself, as we probably should assume it is, we have that first initial pullback, rally up into new highs, and at some point up here, we're probably going to get a nice sizable correction. You know, nothing to like be scared about, but definitely a nice sizable correction. And what do you think is going to be the trigger for that correction? in my opinion, it's going to be the U.S. starting to raise their rates when the Federal Reserve decides to up rates, right? Well, that's coming soon. If we go back and we look at the 1970s and we look at when that pullback happened, I want you to take a look at the distance the market traveled off of lows in its first push, and then take this leg, and you see how it was a little bit further then, not quite 2 targets, but a little bit further than 100% here of this equal leg up, right? Let's take that. Let's take it. Let's go look. Where are we? Well, here's equal legs right here. We're at equal legs in the stock market. In other words, at some point here, and I'm not saying they have to raise rates now, but there's going to be rumors or change in tone. There's going to be something that, there's got to be a really good reason for the stock market to pull back. Each one of these major pullbacks, we had a good reason. All right? So, stock market will probably press a little bit higher, go into overtime on its equal legs, and very likely, so there's still upside. We know in the shorter time frame trends, there's still upside in the stock market, right? And we're going to anticipate it as such. There's no reason to not believe the stock market's heading higher still, okay? I don't want anyone to be confused. However, we need to be aware of and be able to determine when that reversal happens, how we're going to catch that falling knife, because it's definitely a pullback. Let's take it back to the 1970s again. It's definitely a pullback you want to get in on, because the next rally is the rally that's going to take you up 2 targets, through targets, and potentially into the next bull market, where you're going to see now, the rampant run-up and true inflation occur. And this is when rates start to get risen. If we go back, and I want to I want to get I want to go back in time, and let's take a look. This is in 1981. Let's go back and look what the rate decisions were in 1981. So this would have been at the beginning of 81. So May of 1981, they ended up raising rates. Let me see. The changes are all listed in the far left category. Okay, so they raised rates 1 basis point on May 4th. I'm willing to bet anything. Yeah, look at what May's candle. This is May, right here, where my marker is, right before we take the big dive. And of course, and then they lower rates in October, which is of course where October is where you get this little bit of a rally. So definitely going to have probably something to do with rates. And going into in 1980s December. Oh, here you go, December of 1980. November and December of 1980. So at the very end of the year, they raised rates 2 basis points. They went up to, and this is when rates were pretty much as low as, rates were really high at this time still. Let me see. Anyway, point being is rates up, stocks down. Okay? And of course, I think this is important because this is what's going on right now. It's amazing that there was, and I'm going to do a little bit more research into their rate decisions and what I want a historical graph of rates at that time, but I'm going to do some work tonight to try to try to look into this a little bit further, to try to determine what are those early signals for when that top is going to occur in the stock market. But those rate decisions, whether or not they are coming and when they come, most importantly is the market prices that stuff in early. So we're going to see resistance in the stock market. We're going to see the dollar yen already moving off of historical levels. Through it, the rally is going to be already ensued by the time the Fed actually raises rates. Okay, And that's what I'm anticipating and seeing happen in the market. It's a big macro, big global change right now. But guess what? Every sign is pointing to this. The 10-year selling off, 10-year futures, that's rates are rising on the actual traded notes. We've got the S&P up at highs. If they're gonna raise rates, this is when they need to do it. When they can, when inflation is starting to set in, and most importantly, when the U.S. stock market, or when not just the U.S. stock market, but the currency is going to start pricing this in too. And we're seeing kind of a reversal in carry trade. Aussie yen down, dollar yen up. That's one trade. That's the carry trade reversing. And all that can signify is a rate changing on either side. Either Aussie is going to start lowering rates or the U.S. is going to start raising them. That's what the currency market is starting to price in already. And they're going to price it in, and the move is going to already be happening by the time the government, or by the time the central banks actually make the decision, because the smart guys have already figured it out, and the market has already started to price this type of move in. Anyway, so starting off we know we had an all-time pullback in the U.S. stock market, beginning from zero to all-time highs here. No surprise there. We held the 50 back traded, held 61.8 lines, and we have 1960, 1950 upside targets. Most importantly, though, let's take a look at what were we doing off these lows. Well, if we take the 800 anchor to highs, we have the extensions we've been holding for the last 5 years. Once, twice, 3 times. The last time this extension traded was at the 1374s, the highs. We traded at 1086, and then we hit upside targets at 1500. We're looking now for 1374 anchor to all the way up here for a brand new daily extension. We've blown out of our last extension targets, okay? And not saying we couldn't pull back into same anchor new high down at 1300, but more than likely the market's going to do a full halfway back long down to 1219. That would be the major pullback if the market gets one, okay? And it would be a gift. Inside of this level, inside of these daily levels, we know we've had a full long turned into a series. Those broke out of targets. We had extensions that traded once and now twice to target. So we have daily extensions as well that have already traded from the 1421 handle to highs and have now hit our 1750 upside targets. Same anchor new high, somewhere between 1600 and 1575s is our big daily support level for the S&P. So that's where we could pull back just in the near term at a very normal kind of November, December. If it wants to pull back, that's very likely where it's going to occur. Let's go down to a 4-hour chart. This summer we held a full halfway back long for the summer. That trade has gone to and now through its targets, and what we're seeing is the highs of that trade to new highs is what has held as our support. So our 4-hour trend has traded its support level already. All right, and that was at the 1740 level. So we know that the 4-hour trend, the daily trend can continue, and we can keep pulling same anchor new high until we're blue in the face. The 4-hour trend is what's dictating the short-term price action here, as we now have 1790 upside targets. But we just keep pulling those dailies up until the 4-hour trend breaks. But right now the 4-hour trend's valid until it fails. And while we're above 1730, we're still looking for upside targets. Going down to a 15-minute time frame, we've broken the full swing off of lows, looking for that full 15-minute pullback into the 1753s, the full halfway back long, to start the 15-minute trend higher. And now going down to micros. From the micro standpoint, up off of lows, the 1736 lows, we had a full halfway back long. Traded, went to and through targets, traded once, twice in extensions. The extensions broke out of targets. We began new extensions, drawn from the 1757-75 anchor to highs, went to target, same anchor new high. While we're above 1762, we're going to continue higher to the 1773. Below 1762, look for 1753 support on the S&P. And that's it, guys. Otherwise, then it's a retest of 1740. So, all right. Well, that covers about everything today. I hope you guys enjoyed the analysis in the S&P. That's stuff we've been watching at Algo Day Trader over the last, you can ask any of them, for the last year and a half, 2 years. It's been pretty apparent, and we've been trying to keep everybody bullish and on the right side of the market with the S&P. I mean, yeah, there's been opportunities to sell it for scalps and such, but really at the end of the day, you're fighting much larger daily and uptrends, and you're fighting weekly, monthly, daily trends and trying to be a seller. So have a great day, everybody. Goal here, again, just to leave you, the only position I'm in, I'm in dollar yen position still, but the only trade for the scalping room we're concerned with right now is this Aussie US dollar. Like to get it off here. Hopefully one more push into lows will do it for us. You know, any push down into the 93.40, 93.35s, I'm going to take it off. Just get, you know, have a nice little scalp for the day. Again, dollar yen, shallow pullbacks. We're expecting price to start accelerating, and above that 99.40 area, stops are going to start getting run. And it's an open door to 100, and then above 100 is an open door to, you know, 102s. Then now we're talking 103, 4, 5, 6s, and that 108 figure that where the targets ultimately are. Keep in mind one last thing on the dollar yen. We talked about this before, but we're running out of time. And when I say we're running out of time, I mean the amount of time this wave 2 correction took. We're sitting at just about just about that same amount of time that this correction's been underway. So, just from kind of a Fibonacci time standpoint, we're at resolution time for this market, and it's going to go up or down. And personally, I have longs and been trying to be in this long for some time. So, have a great day, everybody, and we'll be back with you as price action develops.